Welcome to Level 5, Financial Markets Explained at ridiculous speed.
Markets are not casinos. They're global trading machines with rules.
Hold the line! Charge!
Magnifying glass over candlestick chart. Zoom from daily candle into microscopic ticks. Each price movement is a response to millions of micro decisions.
Markets operate 24/5 because money never sleeps, and neither do female Caucasian traders.
Stock exchanges are not buildings. They're high-speed computing networks.
Fiber optic cables stretching across oceans. Data flows between continents competing for milliseconds. Trading speed decides winners. Milliseconds decide millions.
Flash. High-frequency trading. Robots trade faster than humans blink. Humans don't move markets anymore. Algorithms do. Robot trader versus confused human meme. Human reaction time slow-mo. By the time you see the news, bots already traded it.
Data feeds, news, and liquidity combine into one equation.
Pollution cloud over price chart. Fear and greed distort the value signal. Markets don't reflect real value, they reflect emotional value.
Financial markets are auction houses powered by emotion and supercomputers.
Money river flows into different asset pools. Pools labeled stocks, bonds, forex, crypto.
Map highlights global capital flow routes. Capital migrates like wildlife. It follows growth, stability, and opportunity.
Interest rate lever moves capital flows. Fed, ECB, and BOJ adjust levers. Raise rates and money migrates to safer assets like bonds.
Yield curve animation bending. Eris bends the curve upward. Bond yields tell you where money is going, not economists on TV.
Commodity wheel spinning, metals, oil, agriculture. Prices rise when demand spikes.
To ensure market stability, we are adjusting the supply downwards.
A unified decision by the organization.
Government decisions can hijack market prices overnight.
FX market as a giant whirlpool. Currencies collide like waves. Currencies trade value of nations, not products. Power versus power.
Euro value fluctuates near ECB building. Euro weakens as ECB tightens late. Rate decisions shape currency strength more than economic growth.
Yen crashes under BOJ loose policy. Japan presses money printer accelerator. Weak currency helps exports. Japan weaponized cheap money.
Look at it go! We just hit the jackpot! Yeah, double up!
Order book liquidity depth. Large buy-sell walls push prices. Liquidity isn't volume, it's the ability to trade without moving price. Shallow liquidity equals volatility spike. Tiny trades shift price massively. Low liquidity markets behave like roller coasters without brakes. Two banks transferring stocks through clearing. Settlement pipeline flashing. Clearinghouses guarantee trades, otherwise markets collapse from default risk.
Papers pile up during settlement freeze. Market stalls, chaos rises. Without settlement, markets don't move, they lock like a frozen game.
Dark pool graph hidden from public. Hidden trades change price silently. Large institutions hide trades to prevent market chaos. Transparency comes later.
Flash leaks from dark pools.
Sentiment drives markets short-term, fundamentals drive them long-term.
Economic data calendar release. CPI, GDP, jobs explode into charts. Markets move before the data. They price expectations, not results.
We are prepared to raise the interest rate by 50 basis points immediately to curb inflation.
Corporate earnings surprise icons. Charts gap up down violently. Earnings reports reset expectations cool. Winners moon, losers crater. Twitter/X breaking news alert.
Bots react instantly.
News doesn't move markets. Reactions to news do. Big asset managers rebalancing portfolios. Indices shift weight. Institutional rebalancing moves entire markets quietly every quarter. Retail trader staring at fraction of chart. Zoom out reveals huge trend. Retail loses by reacting to noise. Institutions win by watching cycles.
Wall Street versus retail seesaw. Retail swings wildly, Wall Street stabilizes. The game looks unpredictable.
Markets aren't gambling when you understand the players and the rules.
Leverage turns normal price drops into disasters. Margin calls accelerate crashes. Margin domino effect chain reaction. Each forced sell pushes prices lower. Forced selling isn't a choice, it's liquidation at gunpoint.
Liquidity shockwave slams market.
Bid-ask spreads widen violently.
In crisis, liquidity dries up first, prices collapse second.
Short seller with binoculars surveying chaos. Charts plunge as shorts profit. Short sellers don't crash the market, they anticipate the crash.
Short squeeze rocket launches. Over-leveraged shorts explode. If too many short, squeeze happens. Losers fuel the moonshot.
GameStop meme army charging forward.
Institutions scramble to cover shorts.
Retail can win, but only when united and patient.
Liquidity pool dries up at market top. Prices fall with no buyers present. Markets crash not because sellers show up, but because buyers vanish.
U.S. Treasury yield spike signal. Global markets shake in response. Bond markets predict recessions. Stocks simply react late.
An inverted yield curve is the market screaming, recession incoming.
Recession clock ticking ominously. Market braces for downturn. Markets price the future, not the present. That's why they panic early.
When crisis hits, capital doesn't disappear. It hides in safer assets.
Global map with trade, growth, inflation arrows. Capital flows shift route. Capital chases countries where growth beats inflation, adjusted for risk. Emerging markets versus developed markets match. Emerging yield beats developed. Higher yield versus higher risk. High rewards attract capital pollute and danger.
Sell the euro, sell everything now. The dollar storm is killing us. We need to hedge the risk immediately.
Interest rates control two monsters, inflation and recession. Balance decides winners.
Oil explodes after geopolitical shock. The markets are reacting to the war instantly.
Supply chain freeze triggers commodity surge. Cargo ships blocked on screen. Supply shocks move prices more violently than demand shocks.
The U.S. infrastructure bill pump effect. Copper and steel charts trend upward. Government spending can boost commodities without printing money. China controls supply chain chunks. Rare earths power modern tech. Their scarcity gives geopolitical power.
Semiconductor supply chain map. Eris highlights Taiwan choke point. Taiwan disruption hits global tech. Chip scarcity raises electronics prices. Commodities inclusion in inflation indexes. Graphs overlay with CPI. Commodity spikes become inflation spikes. Markets react instantly.
Keep buying, the forecast is strong.
We're moving the prices ourselves.
It has to go higher, get me more volume.
Investors pricing future earnings, Eris projects future cash flows. Stocks trade future value. Profits matter, but expectations matter more.
Critics say it's impossible. I say watch us redefine gravity. Our stock knows only up.
Gravity effect on overvaluations.
We are covering the EU inflation price shock panel. European energy prices are spiking.
Japan deflation risk graph. BOJ prints to prevent collapse. Deflation scares central banks more than inflation because it kills spending.
Australia mining stocks versus commodity cycles. Mining rallies with iron ore. Commodities determine Australia's market strength more than banks or tech.
Hedge fund insider whisper meme. Market reacts before news drops. Insiders don't need information. They read data and behavior early.
AI predicts earnings beats. Wall Street uses data models, not instinct. Prediction is mathematics, not emotion.
Retail trader guesswork versus investor logic. Chart shows random picks failing. Retail loses by guessing. Winning requires rule-based decisions.
Markets rotate sectors through cycles. Winners change as cycle turns.
Dividend stocks stabilize portfolio. Utilities and staples hold strong. Income stocks act as anchors during storms. Slow but steady.
Small cap stocks erupt during recovery. Risk on begins again when recession fear fades. Small caps lead the recovery.
Don't forget to subscribe. How normal people actually win in markets. Not by luck, but by rules. You'll learn the cheat codes in the next block, if you're brave enough to use them.
Institutions don't react to news. They anticipate it and position early.
Global headlines analyzed. Sentiment index spiking in technology sector. Probability of market shift at 72%. Neutralizing emotional variables.
Market open volume explosion. Orders flood in at once. Most market movement happens at open and close. That's when big money acts.
Quarter-end portfolio rotation. Huge blocks of stocks change hands quietly. Institutions rotate billions across sectors while retail sees random moves. Whales quietly adjusting bond via stock allocation. Yield curve pulses while equities shift.
GDP, inflation, unemployment arrows linked to rate decisions. Banks adjust policy levers. Markets don't follow economics. Markets follow expectations of economics.
Commercial traders hedging commodity contracts. Hedgers protect against oil, wheat, metal risk. Hedging reduces risk for producers. Speculation amplified risk for traders.
Speculators versus producers tug of war. Prices swing wildly depending on who dominates. Without speculators, markets move slow. Without hedgers, markets implode.
HFT bots filling liquidity gaps. Bots stabilize spreads temporarily. Bots create liquidity when calm, destroy it during fear.
Flash crash triggered by small error. Code bug ripples through market. One bad algorithm can cause billions in losses in under a minute.
Dark pool iceberg order. Hidden size larger than public order. Markets react to visible information, not real size of trades. Massive sovereign wealth fund allocation shift. Global markets shake. When nations invest, markets obey, trillions move at once. Liquidity drought versus liquidity flood imagery. Capital dries up or overflows. Liquidity determines direction, news only determines speed.
Central bank stepping in as lender of last resort.
Market panic stops immediately.
Banks don't rescue markets, central banks rescue markets.
everything! It's crashing! Get out now!
The data confirms stabilization. We should hold.
Currency whales shifting global FX positions.
Dollar, euro, yen swing aggressively.
Forex is the biggest market. It controls all other markets.
Commodity war room strategies. Producers cut output, traders bid higher. Supply decisions drive price direction more than demand forecasts.
Market players ranked like a boss tier list. Central banks at top, retail at bottom. To understand markets, follow power, not analysts.
Retail emotional panic meter. Fear and greed spike red and green. Emotions move money faster than logic, especially among small investors.
High-fee termites devouring portfolio. ERA eliminates fees.
Smart investors reduce taxes legally. That's hidden profit.
Investor wins by sitting still. Bots race. Bots fight violently. Calm investor ignores. Sometimes doing nothing beats Wall Street. Stillness is a strategy.
Portfolio map aligned to risk tolerance. Eris tailors portfolio by persona.
Investing is a map, not a race. The prize is freedom, not excitement.
Fortunes are built slowly. Gambling builds stories, not wealth.
Market chaos versus disciplined investor checklist. Checklist blocks chaos. Disciplined rules outperform brilliant guesses.
Patience compounding beats flashy trades every time.
Investing correctly buys time, freedom, and choice, not just money.
Final market recap montage. Whales, bots, policy, ETFs, cycles flash quickly. You don't need to beat markets. You need to understand and ride them.
Next level unlocked. Derivatives. Wall Street's hidden superweapons. Be ready.
Dark derivatives casino. Roulette wheel made of contracts spins. Derivatives are not gambling. They're how the market hedges reality.